Welcome to this Insolvency Trends webinar. This is really the data behind the Business Risk Index that CreditorWatch releases each month. I always like to think about the big forces that are affecting the outlook because they're the ones that are really developing what businesses are facing, how the economy develops. So probably in order, in terms of the shorter term pressures, there's obviously Mr. Trump's tariff policies. They're still to be decided on. We're coming up to July the 9th, which is a very important date to see what trade deals are done, how high tariffs are. The second dot point there, the big dot point, I think the ongoing combined pressures from higher prices and costs. Inflation's going back to the band, to target at 2.5%, but that doesn't mean costs have gone down either for consumers or for businesses. So it's still a big pressure on many businesses and on the consumer. So that's a big factor that's still impacting the economy and businesses. And then the population was growing very strongly the last couple of years after borders reopened after COVID. It's going to be growing a bit more slowly going forward, and I think that's probably an underappreciated factor in how good the economy was previously, and it probably means things will be a bit slower. So there's a lot of forces there. There's also these very big forces which I call megatrends. These are changing the economy, not in just the next 1 or 2 years, like those other factors I'm talking about, but these change how businesses develop over decades. So AI technology, we can't not talk about AI at the moment. Climate change, energy transition, obviously the aging population. Geopolitics has been very much to the fore in the last month. And I think another one is just this rising inequality that's creating a lot of pressures for government. So a big set of forces to look through, and those are really what's behind what's going on in the economy and for many businesses. So let's kick off. The RBA was forecasting a pretty soft landing, near perfect soft landing. They don't very often happen. Actually, what we have seen recently is that the data was really backing up that forecast. Now, I think Mr. Trump is going to actually make the landing a bit bumpier, but generally speaking, inflation is moderating. That's allowing the Reserve Bank to cut interest rates. We think they'll cut them another twice next month in July, probably August as well, later this year, and probably early next year. So probably another 2-3 interest rate cuts this year. That will be helpful. That will help the economy strengthen, and it will help keep unemployment very low. And that would be very helpful for credit cycles, for consumer demand, for businesses. Now, what we have seen recently is consumers were reporting very poor confidence in 23-24. Really, that was not because particularly interest rates went up. It was all about the cost of living, how high that was. And what we saw when the income tax cuts happened in the middle of last year, when the government, the federal government and other governments provided cost of living support, we saw an improvement. Now, consumers are still net pessimistic below the 100 line, but they're not as pessimistic as they were previously. This was the point about inflation. So you can see the cost of living. So the RBA is forecasting inflation will return to a 2.5% rate of increase, but you can see that big jump up in the costs. The CPI is effectively a measure of the cost of living. So it's about 20% higher than it was in the middle of or before COVID, and a lot of that's occurred since 2021. So we all feel that in our hip pockets as consumers, but businesses also have seen a very big increase in business costs. And those costs aren't going back. Like, prices are not falling, they're just rising at a slower rate than before, than during that very strong period. Businesses, I like to follow the NAB Business Survey. The latest survey had businesses reporting the weakest business conditions since outside of the COVID period, really way back into the early 2010s, when we're in the aftermath of the global financial crisis. Hopefully some of that was just uncertainty related to initial tariff announcements. We'll need to see that next month if that bounces back. If not, that's a pretty good sign that interest rates should be coming down. So it's a really good indicator of interest rates. When we look at which businesses are telling us times are tough or reporting very tough conditions, it's really manufacturing and retail. They've been reporting very tough conditions for some time, but most businesses have seen conditions deteriorate in recent times. The best performing transport, utilities, mining, a bit volatile, and then some of the services sectors are doing all right as well. By state, Victoria's the weakest, Queensland's the best, but notice that New South Wales, Western Australia have deteriorated recently. So, and even Queensland is not as strong as it was. So the big states are saying, or 3 of the 4 big states have been easing, and 1 is quite weak. So it's saying the economy is not super robust. It's not saying it's really bad, but it is consistent with the Reserve Bank needing to cut interest rates some more. So that's the background to what's been going on. What we've seen in terms of insolvencies is they've risen very strongly, sharply. They were very low during COVID when the tax office wasn't pursuing debts, and also when there was so much government support for both consumers and businesses. What we're suggesting at the moment, if you can look at the 2 black lines there, we're actually seeing insolvencies level out, albeit at high levels. So we're not saying this is saying things are getting a lot better, but they've stopped getting worse. And we think those tax cuts and the cost of living support from the government was pretty important there. When we look at the sectors that had the worst, we've had the worst pressures, it's really been hospitality and construction. And they reflect those probably the biggest forces. So costs increasing, so a lot of energy costs, whether it's electricity or gas prices or oil prices, and also discretionary spending. So hospitality is really pressured on both sides there. But again, both of them look like they have leveled out again at quite high levels. We've been modelling insolvencies, and what we can see is that interest rates, which really likely pick up a lot of those costs because interest rates are moved in relation to inflation, the energy prices, oil prices, electricity, gas prices, and the Aussie dollar, which translates a lot of those energy prices from US dollars into A dollars, have been those big factors driving the insolvency rate. So the one part of that is improving is the interest rate environment. Also energy prices, I guess, oil prices have come down a bit recently. But a lot of those other prices, electricity, gas prices, are still very high. Some of our proprietary indicators, so we follow and publish trade payment defaults. That's when a business on the CreditorWatch platform registers a payment default against another business. Now, what you can see, really the red bars there, if you get 2 or more businesses saying that you are not paying your bills, then the risk of insolvency in the next 12 months goes up to between something like 13 and 18% for those 2 or more. So it's pretty significant. It's a great series to watch and be informed of on our site. Again, when I look at the trade payment defaults in aggregate, I can see that after rising like insolvencies did, they have leveled off in recent months. So I think I view that as a confirming force for the what we've seen in the insolvencies, which have leveled off at those higher rates. The sectors that have been worst, as we saw previously, particularly hospitality, but also construction. What are some of the other factors driving those very high insolvency rates? Well, part of it is the tax defaults that these companies have run up. Now, this is data from the ATO. The right-hand scale shows that there are 30,000 businesses that we're aware of that have a tax debt of over $100,000. And that's run up very sharply from September 23, when the ATO recommenced its normal collections activities. Again, though, it's leveled out in recent times, so we're not seeing a lot of new businesses being added. So that probably is part of the story about why insolvencies have leveled out as well. This is a big red flag. It's certainly something that anyone in a credit department should be checking when, as part of their job. When a company has a tax default over 100,000, our data suggests that there's a pretty high probability of default or insolvency. So it's a real red flag. It's one to always check. What we have seen, though, when we look at the types of insolvencies, we're actually seeing a lot of sole traders, and we're actually seeing, even within those proprietary companies, of which there's a lot of construction companies as well, they're pretty small companies, not employing very many. So this insolvency spike that we've seen, or the rises, have particularly been about small businesses, sole traders. And while that's obviously very challenging for those businesses, the one, I guess, positive for the whole economy is it hasn't led to a lot of unemployment, and it hasn't had a lot of domino effects in insolvencies. The other things that you can get off our system, which are really worth looking at, are our payment rating scales. So when you look at a company, you can see how they compare in terms of their payments compared to others in the industry. If you have a D or E rating, then you have a much higher chance of becoming insolvent. Doesn't mean you will, but it's another piece of information that you can follow. We also track, we call it the Business Risk Index. This is a combination of both economic factors and then credit factors. And you can see the best business, the best districts still have a default rate somewhere between 4 and 5%, or have had over the last year. The worst districts, however, have a default rate somewhere between 6.5% and nearly 9%. So again, that business risk index is useful when you're looking at businesses in particular regions. The regions that have been most challenged tend to be lower socioeconomic regions, often with an exposure to property as well, and perhaps more small businesses in them. So that's the end of the show. Thank you for joining us today. And if there are any questions, please send them through. I guess the bottom line is that the economy it's been a challenging period for businesses, particularly small businesses. And I think we're not out of the woods yet. Lower interest rates are going to help somewhat, and that's a good part, but there's still some challenges with those previous higher costs to work through. Thank you.